Let me ask you something personal. If someone handed you a check for $150,000 and said, "This money is yours, but only if you act before a specific deadline," would you take it seriously? Of course you would. Now, what if I told you that exact opportunity exists inside your retirement accounts right now? And the deadline is not something a bank set or a broker invented. It was set by the IRS, and most Americans have no idea it is happening to them. If you're between 65 and 75 years old, you're sitting inside one of the rarest financial opportunities of your entire life. Not because of anything you did, not because of a special account or a lucky investment, simply because of your age and the way the American tax code is written. This opportunity has a closing date, and that closing date is determined by your age. For tens of millions of retirees, this window is quietly closing right now without them ever knowing it existed. By the end of this video, you are going to understand exactly what this opportunity is, why it is worth more than any single investment decision you have probably ever made, and what you can do starting this week to take full advantage of it before it disappears. Stay with me, because what I am about to show you changes everything about how you look at your retirement savings. My name is John. Everything in this video is educational and based on publicly available 2026 IRS rules and current federal tax law. I'm not a licensed financial advisor, CPA, or tax attorney. Your personal situation is unique, and before making any changes to your accounts, please work with a qualified fee-only tax professional who can review your specific numbers. Now let us get into what could be the most important 12 minutes of your retirement planning. Here is something most people believe about retirement taxes. They believe their taxes will automatically go down once they stop working. And for the first year or two, that often feels true. The salary is gone. The paycheck stops. The big income that was driving the tax bill disappears. It feels lighter. It feels simpler. And right there, in that feeling of relief, is where the problem begins. Because what most retirees do not realize is that a second tax chapter is already being written in the background. It does not start with a letter from the IRS. It does not announce itself. It builds quietly inside every traditional 401k and traditional IRA you have ever contributed to. And then one day, on a schedule you did not choose and cannot negotiate, it activates. And when it does, it can cost you more in taxes during retirement than you ever paid during your working years. That activation has a name. It is called the required minimum distribution, and understanding it is the foundation of everything else we are going to talk about today. For your entire career, every dollar you contributed to a traditional 401k or traditional IRA went in before taxes. The IRS allowed that. They gave you a deduction, let your money grow for decades, and never collected a single dollar along the way. But they were never giving you that money. They were lending you a delay. And when you reach a certain age, that delay ends. Under current law, most people born before 1960 must begin taking required minimum distributions at age 73. If you were born in 1960 or later, that age is scheduled to be 75. At that point, the IRS requires you to withdraw a calculated amount from your traditional retirement accounts every single year, whether you need the money or not. That withdrawal is added to your income and taxed at ordinary income rates, the same rates that applied to your paycheck when you were working. And here is what makes this genuinely difficult. The calculation the IRS uses means your required withdrawal grows larger every year, not smaller. At 73, your first distribution might feel manageable. But by 78, by 82, by 85, that number keeps climbing. It stacks on top of your Social Security income. It can push more of your Social Security into the taxable zone. It can trigger surcharges on your Medicare premiums that most retirees never see coming. And it can push you into a higher tax bracket at exactly the age when you have the least flexibility to respond. But here is what changes everything. Before that age arrives, there is a stretch of years where none of that has happened yet. Your salary is gone, so your employment income is zero. If you have been smart about timing, your Social Security may not have started yet. Your required distributions have not begun. For a period of years that might be as short as 2 or 3 or as long as 8 to 10, your taxable income can be genuinely historically low. Lower than it was when you were 30, lower than it will ever be again for the rest of your life. That stretch of years is the opportunity. That is the window worth potentially $150,000 over the course of your retirement. And right now I want to explain the 4 ways you can use it, because each one works differently, and together they compound into something that can fundamentally change your financial outcome. The first and most powerful way to use this opportunity involves a decision about your traditional retirement accounts. Think about what sits inside your 401k or traditional IRA. Every dollar in there has never been taxed. One day, all of it will be. The question was never if. The question has always been when and at what rate. During your low-income years, you have the ability to move money from those pre-tax accounts into a Roth IRA. You pay tax on the amount you move, but you pay it now, at the lowest rate you may see for the rest of your retirement. Once that money is inside a Roth IRA, it grows without any further taxes. It comes out in retirement completely tax-free. And most importantly, a Roth IRA has no required minimum distributions. The IRS cannot force you to pull money out on a government schedule. Consider a retired couple, both 66 years old, with $700,000 sitting in a traditional 401k. They have delayed Social Security. They have no pension. Their only income right now is modest withdrawals to cover living expenses. In 2026, after their standard deductions, including the additional amounts available to people over 65, they have meaningful room to realize additional income while staying in the lower federal tax brackets. If they move $70,000 per year from their 401k into a Roth IRA over the next 5 years, they pay roughly $8,400 in federal tax each year at the 12% rate. That is $42,000 total across 5 years. That might sound like a significant payment, but now look at the alternative. If they do nothing, that $700,000 continues growing. By the time required distributions begin, the account may be worth close to $1 million. Their first required withdrawal could be $38,000 or more. By their late 70s, it could easily exceed $50,000 per year. Stacked on top of Social Security, that income pushes them into the 22% bracket or higher. Over 20 years of required distributions, the federal tax bill on the same money at that higher rate could run $90,000 to $120,000 more than what they would have paid during the low-income years. Same savings, same lifestyle, completely different tax bill. Now, I want to tell you about something that surprises almost everyone who hears it for the first time, because most people assume that taxes on investment gains are unavoidable. They are not, at least not during this opportunity window. In 2026, the federal long-term capital gains tax rate drops to 0 for married couples with taxable income below $98,900, and for single filers below $49,450, 0%. If you own stocks, mutual funds, or ETFs in a regular taxable brokerage account, not inside a retirement account, and those investments have grown over the years, you may be able to sell them during your low-income years and owe absolutely nothing in federal capital gains tax. Here is why this matters more than most people realize. If you hold onto those appreciated investments and sell them later, after Social Security has started and required distributions have pushed your income higher, those same gains will likely be taxed at 15% or more. By selling during the low-income years and immediately buying back similar investments, you reset your cost basis to today's price. You have permanently eliminated years of embedded gains at 0 federal cost. The investment does not change. The risk does not change. Only the tax bill disappears. A couple who has $80,000 of embedded gains in their taxable accounts, harvested at 0% during this opportunity, saves $12,000 to $15,000 compared to selling those same positions 5 or 8 years later when their income is higher. That is money that stays in their pocket for doing nothing more than acting at the right time. Now let us talk about Social Security, because the timing of when you claim your benefit has a tax consequence that almost nobody discusses when they are making this decision. Most people think about Social Security timing in terms of monthly benefit amounts. Claim early and get less, claim late and get more. That math is real and important. But there is a second layer most people miss entirely. Your Social Security benefit, once it begins, adds to your annual income. And depending on how much total income you have, up to 85 cents of every dollar in Social Security benefits can become federally taxable. When your retirement account distributions are already filling your low-income years with taxable income, adding Social Security on top compresses the space you have for lower bracket planning. Every dollar of Social Security that enters your income is a dollar of conversion space, or capital gain harvesting space that disappears. For retirees in good health, with adequate cash flow to cover expenses, delaying Social Security can keep this opportunity window wider and more useful for the other strategies we have discussed. Each year of delay also increases your eventual monthly benefit, meaning when Social Security does begin, it arrives as a larger permanent income stream that is actually worth more in purchasing power. The tax efficiency and the lifetime income increase point in the same direction, which is relatively rare in retirement planning. There's one more piece of this opportunity that I want to walk you through, because it is the quietest of the 4 strategies, and possibly the most consistently underused. Every type of investment generates a different kind of tax event. Bond funds and real estate investment trusts generate regular interest and dividend payments. Those payments are taxed as ordinary income, the same rate as your salary, the same rate as your required distributions. If those investments are sitting in a regular taxable brokerage account, that income hits your tax return automatically every year. You cannot defer it. You cannot avoid it. It simply adds to your income every January, whether you want it or not. Stock index funds that grow primarily through price appreciation rather than regular dividend payments generate far less automatic taxable income. The gain only becomes taxable when you sell, and as we just discussed, during your low-income years, that gain may be taxable at 0%. The move here is simply to put the right investment in the right account. Move bond funds and income-generating holdings into your traditional IRA or Roth IRA, where that income is either deferred or permanently sheltered. Hold tax-efficient growth investments in your taxable brokerage account, where the appreciation grows quietly and can potentially be harvested at favorable rates during the right years. Independent research on this strategy, called asset location, consistently shows it adds between 0.5% and 1% of after-tax return annually to a retirement portfolio without changing any investment at all. On a $500,000 portfolio over 25 years, that improvement compounds into tens of thousands of dollars of additional wealth. Same investments, same risk, just better placement. Here's what I want you to really sit with before this video ends. The strategies I just described are not complicated. They do not require genius. They do not require specialized accounts or exotic financial products. They require one thing: acting during the right years. And the right years are now, or soon, or for some of you, already running short. The people who will pay the most in retirement taxes are not the careless ones. They are not the ones who made bad investments. They are the ones who simply did not know this opportunity existed, waited too long to ask the right questions, and then watched the IRS collect on a schedule that could have been reduced dramatically with a few years of intentional planning. If your combined traditional 401k and IRA balance is above $300,000, your first action this week should be finding a fee-only tax planner, not a broker, not a product salesperson, someone who charges for advice and earns nothing from what you buy. Ask them to model your specific bracket situation, your Medicare exposure, and what a structured multi-year Roth conversion plan could save you over the course of your retirement. If you own appreciated investments in a taxable brokerage account, open that account today and write down every position, what you paid and what it is worth now. That gap is your embedded gain. Whether you can harvest it at 0% this year is a question your income level will answer. And if you have not yet decided when to claim Social Security, please do not make that decision based solely on the monthly benefit chart. Run the tax modeling first. The interaction between Social Security timing and this opportunity window is worth real money, and it deserves real analysis. This opportunity between 65 and 75 will not send you a reminder. It will not show up in your brokerage statement. Nobody from the IRS is going to call and suggest you use it wisely. It simply opens, stays available for a few years, and then closes. What happens inside those years determines a number that could be $150,000 or more in taxes paid or saved on the exact same money. You now know this opportunity exists. You now know what to do with it. The only thing left is deciding whether this is the week you finally act. If this video gave you something genuinely useful, please hit the like button right now. It takes 1 second, and it helps this channel reach more retirees who need to understand this before their opportunity closes. Subscribe if you want to keep getting the real tax picture every week in plain English. And if you know someone between 62 and 72 who has not thought about this yet, share this video with them today. Not next week. Today. Because this opportunity does not wait. Next week, I'm going to show you the single most overlooked line on the Medicare enrollment form that can cost retirees thousands of dollars per year in permanent premium increases. Most people never see it coming. Subscribe and hit the bell so you do not miss it.